Alhamdulillah Rabbil Alameen. Wassalatu wassalamu ala Muhammadin Sayyidil Mursaleen wa ala alihi ajma'in. Thank you very much, Taif Digital Institute for Islamic Finance, to organize this webinar together with Adal Advisory. And thank you, Brother Ahsan, for giving a quick, sweet and concise introduction for the webinar today. I hope, and also thank you to everyone who have joined for this session from various parts of the world. So as Brother Ahsan was mentioning, the webinar today, which is about CSAA preparation. I'm sure many of you are going to attempt the exam that is going to happen in this month. So it will be, inshallah, an opportunity to share and learn some of the important aspects of the exam, as well as relook at some of the questions that you might have. So really appreciate if you can ask your questions in the Q&A tab, or even in the comments tab, and inshallah we'll try to address. So before I start, a quick disclaimer that many of the questions you have, maybe I would not be able to answer. I'm also a student of knowledge, trying to enrich my understanding and learning every now and then. However, inshallah, we'll try to attempt the questions that you have asked to the best of my understanding, inshallah. So before we start, a quick introduction of the CSAA exam. We don't need to introduce AAOIFI. I'm sure all of you know that AAOIFI stands for Accounting and Auditing Organization for Islamic Financial Institutions, and it was established to facilitate harmonization or standardization in terms of Sharia, in terms of governance, audit, accounting, and ethics practices throughout the Islamic financial institutions throughout the globe. So when it comes to Islamic banking, Islamic insurance, sukuk, then even today Islamic fintech, all of us, we refer back to AAOIFI standards every now and then. For students of knowledge, for academia, for researchers, for Sharia graduates, even for the professionals and practitioners, the standards have been tremendous guidelines for us to look at every now and then, take lessons, take understanding, inspiration, and try to apply those in our real world applications. We are very grateful for all the scholars and the team that AAOIFI had from the beginning until today. Jazakumullahu khairan ahsan al-jaza. So these exams, the CSAA and the CIPA, are the two flagship exams that AAOIFI has introduced and has been there for quite some time. And CSAA stands for Certified Sharia Advisor and Auditor. CIPA stands for Certified Islamic Professional Accountant. So the difference between the two certifications is that CSAA was meant to be more for Sharia graduates or those who aspire themselves to be sitting in any of the Sharia functions. And CIPA is more general for anyone who would be either a practitioner or an academician in the Islamic finance world. However, CSAA, because of its simplicity in the sense that the exam so far included only the Sharia standards, we have seen a trend that many professionals, even not coming from Sharia background, also trying their best to attend the exam, and mashallah, they have also got certified. However, after the exam, the next exam, as we have received the notification from AAOIFI formally, that this would be the last CSA exam in this June, inshallah, as the inauguration of the new format of CSA exam has already happened during the AAOIFI Sharia Board's conference earlier last month in Bahrain. So we hope that this will be the last one. However, inshallah, there will be a few more simple certifications also introduced, which AAOIFI will announce very soon, inshallah. I believe some of those are already announced in the website. Some of those will come soon, inshallah. Anyway, so let's go directly to some of the questions that we have received. And after that, inshallah, we'll try to take more questions from those who have been attending the session today. So again, please feel free to ask questions in the Q&A tab so that we can address inshallah. Okay, I think I mentioned about the AAOIFI CSA exam in general. There has been a question to introduce the AAOIFI exams and the importance and the procedure to get the certificate in general. So in general, for now, until today, I mean, for the next exam, inshallah, as well, the procedure to get this certification is that you have to register for the exam through a registered exam center. And then the examination curriculum so far has been Sharia standards 1 until 48 and the government standards 1 until 4. So those are the 52 standards that you have to read thoroughly, understand, and take notes. And based on those, there will be a online exam. Of course, the exam has to be taken participation in most cases, in most countries where there is an registered exam center. You have to go to the exam center, but the exam will be conducted online. And there will be 100 questions in a MCQ format. So there will be choices, up to 4 choices, and you have to select the right answer. There is no negative marks. If there's a mistake, then the number will just be deducted. That's it. I mean, you don't get the number. You don't get the points. That's it. But otherwise, there's no negative marking. And yeah, I think around 70% is the passing marks, if I'm not mistaken. So there has been some question about will September 2023, there will be change in the exam pattern. Not September. I think the message that we have received from AAOIFI, September will still be there for those who want to retake, who has failed in the previous exams and they want to retake. But after that, inshallah, it will be discontinued. Is there any online resource available for CSA exam preparation? Someone asked this question. I think now there are many resources. With Taif, there is a question bank. I think with Ahsan, you can introduce that, which people can utilize to just quickly check some of the concepts and prepare. But the best preparation to me is actually going to the holy standards few times, at least 2 to 3 times, and take important notes, understand every single process, because this is not only preparing for the exam, this is also for preparing and enriching the knowledge so that in future, inshallah, wherever you are, whichever functions you are fulfilling, you can do that according to AAOIFI Sharia standards. So every single clause matter. It's not that we will just prepare based on selective clauses or selective standards. It doesn't work that way. So the next question was, what should be the best action plan to prepare for the exams? Again, I stress a lot on finishing all the standards end to end, and not to study selectively. However, for the exam preparation, the basis, Sharia basis, is not so important in the sense that questions may not come from the Sharia basis. However, Sharia basis are still important to understand the rationale behind, understand the logic behind. When we understand the rationale behind the clauses, it is easier for us to solve newer problems, things that are new to us, issues and challenges which are not covered directly within the Sharia standards. But as long as we understand the underlying rationale from Sharia point of view, it will be easier to solve and look at from that perspective. So definitely the Sharia basis are very important. But for the sake of exams, most cases, the exams will be limited to the questions will be limited to the statements of the standards, right? So all the standards must be read end to end together with the definitions. In some standards, there is some appendix where we can find some important definitions related to that particular standard. So those needs to be taken well noted. Similarly, some of the definitions are within the standards, within the clauses. We need to really take notes of those as well. And finally, all the clauses matter. There is no way to say that those are the important clauses. You just prepare based on that. If someone promises like that, I never agree with that. All that I would say, please finish the entire Sharia standards end to end, including the 4 governance standards. So yeah, that's the best action to prepare for the exams. And the model questions, you may find some of the model questions or even the mock questions like Taif also has. Those are just to check the understanding, just to check how prepared you are, not to take those as a basis for preparation, right? So I think there is a good distinction between the two, and I hope everyone understands that. All right. So there is another question in the Q&A box. Can you explain me about IFQ but CSI? I'm sorry for that. I cannot explain the entire structure of IFQ. I'm not familiar with that. And as the session today is about IOFI's exam, it's better that we stick to that. Jazakallah khairan for your question. All right. There is another general question about the exam. And after this, inshallah, we'll go into the particular questions about the standards. So this question comes from Malaysia. The question says, why is it many people who study at Malaysia do not pass the CSA exam? I don't know. I find the question a bit weird because I also appeared for the CSA exam from Malaysia, from one of the centers in Malaysia. And I found many of the colleagues also passed from Malaysia. Nonetheless, if wherever you are, if you want to prepare for a CSA exam, there are, mashallah, good courses in Taif. Also, there are good learning programs. At Adil Advisory, we also started conducting learning programs. And alhamdulillah, we have extensive experience in conducting training programs based on the Sharia standards in various countries. So inshallah, we'll be able to help you understand that. I think the first and foremost, the most important part is to understand the clauses. If we understand the clauses, passing exam is not a big deal. But if we don't understand, as I mentioned, if we are very selective, then this is where the problem will happen. All right, so inshallah, let me start with some of the questions asked in particularly for some standards. So what I will do, I will share my screen from my tablet and basically try to navigate through the different Sharia standards as we try to address some of the questions particular to the standards, inshallah. So here it is. Okay. So the first question is about Ijara Mawsufa fi Dhimma. The questioner asked the question, Brother Ahsan, perhaps if you can also help me by pasting the question in the chat box so others can also see. So the question says, can Ijara Mawsufa fi Dhimma be used for offering education and health services? In general, yes. Ijara Mawsufa fi Dhimma, if you look at this standard, which is standard number 9, Ijara Mawsufa fi Dhimma denotes that Ijara, a service agreement, is conducted based on a service that will be delivered later on. So that's the essence of Ijara Mawsufa fi Dhimma. Now, if we consider any service which is halal, which is deliverable, which can be defined, then yes, it can also come under the concept of Ijara Mawsufa fi Dhimma. For example, if we want to offer education, so let's say a university wants to sell a program, a master's degree or PhD degree or whatever, based on Ijara Mawsufa fi Dhimma, meaning that, let's say the program will start after a couple of months or maybe next year, but they want to sell the program right away. So that's exactly Ijara Mawsufa fi Dhimma. Now, most probably the questioner wanted to ask if we can structure this through Islamic financial institution as a financing mode. In other words, Islamic financial institutions would offer the education, the health services, financing based on Ijara Mawsufa fi Dhimma. So this is where there will be basically a tri-party arrangement, right? So Islamic financial institution would have to purchase the education plan, the health plan, or the package from the university, from the provider, from the health service provider, maybe from the hospital, and sell that package to the client. Now, is it theoretically possible? Yes, it is possible. How? So this is where we have to dig deeper because we have to be careful some of the things which can be delivered from one party to the other party. It can be quantified and defined. So some of the micro particulars would come into the picture. But in general, yes, it is possible. All right. The next question is about in the same standard, Sharia standard number 9 on Ijara and Ijara Muntahib Tamliq. what does the standard mean regarding accelerating payment? So accelerating payment in general means that we will, if someone defaults, I couldn't have time to go through the particular clause. We would really appreciate if you mention the number of the clause so that we can, refer back easily. But in general, accelerating payment denotes that, let's say there is a payment plan, installment payment plan, or a deferred payment plan, and the payment will come across number of months or in a delayed matter, in a deferred matter. However, there has been a default, or there has been some issue because of which the right to pay in a deferred manner needs to be taken back. See, when we conduct a sale agreement, when we conduct a service agreement, the seller has the right to receive the payment, and the buyer has the right to receive the asset or commodity or the mal. In ijara, the seller has the tenant or the lessor has the right to get the ujra, the service fee. Either we call lessor or we call service provider. And on the other hand, the service recipient or a lessee, he has the right to receive the utility, the benefit. In this case, let's say education, healthcare services, etc. So what happens in a deferred payment arrangement? The seller or the lessor or the service provider, they waive their right to receive the payment until an agreed point. So what happens when there is a default of payment? They take back the waiver that they have given. So now what it means is that the payment needs to be accelerated. The payment needs to be made on a instant basis or as soon as possible basis, without the deferment that was given originally or during the contract. So I think in general, that's what accelerating payment means. Anyway, there has been another question about the clause 8. So let's go to clause 8 and 8.1 in the same standard of ijara. I think this is here. Yeah, exactly. So the question says transfer of the ownership in the leased property in ijara. Okay, this one. And he quotes the standard, the clause. In ijara muntahi bit tamlik, but the method of transferring the title in the leased asset to the lessee must be evidenced in a document separate from the ijara contract using one of the following methods, right? Is it? Yeah, okay. By means of a promise of sale, or by accelerating payment, he actually quoted this one. I think he mentioned here, token or other consideration. Or is this? By means of a promise to sell for a token or other consideration, or by accelerating the payment of the remaining amount of rental. Okay, so we have accelerating here. The surah or the scenario that I was mentioning was in the case of default. In this case, it's not a default. However, we can still accelerate the payment to consider this as a consideration of the sale. Okay, how it will happen? So what is the clause is saying is that in a ijara muntahi bit tamlik. So what happens in a ijara muntahi bit tamlik? So for example, the financial institution has rented out a particular asset to that client. Okay, let's say it's a house. It's a house financing through ijara muntahi bit tamlik. Ijara muntahi bit tamlik means that it's a lease contract which ends with transfer of ownership, meaning that at the end of the day, the lessee will own the property. Okay, so in this case, let's say the client got a financing from the financial institution, and the term is that at the end of the term or at the end of the maturity, he will own the property. So what it's saying in this clause is that at the end of the day, when the transfer of the title needs to be there, so this needs to be evidenced in a document separate from the ijara contract, because the ijara contract is only about the lease, only about the lease of the property, only about the lease of the asset. When we are saying that the property will be transferred, the ownership will be transferred to the client, it should be based on a separate contract. Now, what would that be contract? What would that contract be? So it could be, first of all, it could be a promise. I mean, when the initial phase, there could be a wa'ad, there could be a promise to sell, meaning that the financial institution is saying that, we promise that we will sell the property for a token. So they can say for $10, $100, something like that, or other consideration, or any other such payment, or by accelerating the payment of the remaining amount of rental. So let's say it was a financing for 5 years, and after 4 years, the client expressed that I just want to take the ownership now. So what they can say in the wa'ad, that maybe, if you pay the remaining rentals, all the amount that accumulate as a remaining rental, so that would be considered as a consideration, as a price for the property, and based on that, the sale happens. So this is what accelerating the remaining payment is meant by in this particular clause. Or there could be another way of defining the price, is that the wa'ad would say that we will sell, we make wa'ad, we make promise to sell this property to you as a client at a price, or at a market value at the time when we are going to sign this agreement. So that is also a valid way to conduct this. So what will happen at that particular period, based on the wa'ad that has been signed previously? Remember, this is not an agreement, this is a wa'ad, this is a promise. So based on the promise, at the later point of time, when the specific time period comes, there will be either a price based on that token price, or any other price, or accelerating the remaining amount of rentals. And let's say the example that I gave for the last one remaining year, or the market value. In the case of market value, they also have to have some agreement, and there will be a sale and purchase agreement. There will be a sale and purchase agreement where the asset is the property itself, and the price is whatever mentioned in this wa'ad. So I hope this is clarified. There is next question. Next question is about Sharia standard number 40. So let's go navigate to Sharia standard number 40. Okay, here it is. So Sharia standard number 40 is about distribution of profit in mudaraba based investment accounts. So in some countries, not all the countries, there are investment accounts similar to deposits. However, it is structured in a manner that there are some additional risks for the investment accounts holders, and thus they also enjoy some additional profits. So this standard is about distribution mechanisms for profit distribution mechanisms for such mudaraba-based investment accounts. Okay, so the question is about clause 225. Let's navigate clause number 225. Okay, I guess this one. So what the question is, in case of depositing points or paper money by handling them over to the cashier, and the institution may charge a fee for transportation, storage, blah, blah, blah. This, however, does not include amounts to the transfer. Okay. And then pertaining to SS 43122, why is the mudarib not allowed to expense this cost in this situation? Sorry. Investment account should also not be charged with the expenses of the tasks which have to be performed by the mudarib. Such expenses include the expenses of the investment departments and the bodies which endorse their decisions, as well as the expenses of the follow-up and accounting departments. Okay, so let's navigate to 3122 first, and then come back here. Okay, so this is basically, let's go here. Firstly, when it comes to realization of profit, you will see the echo of similar methodology when it comes to musharaka or mudaraba standards as well. So this standard is just taking one application of mudaraba and try to reapply the principles. Okay, so it's no different. It's the same thing that we understand from the Mudaraba standards as well. What it's saying is that how we are going to realize profit in such investment accounts. So firstly, we have to ensure that the capital is safe, meaning that let's say there has been a total capital pool of $1 million in the investment account, right? So how we are going to calculate profit? First, when we have the revenue, profit is a function of revenues, total revenue minus total expenses. So we have to first deduct all the expenses from the revenues and then see how much we are left with. So if we are left with something where the capital is still intact, meaning that we still have $1 million, and beyond that, we have $1.1 million. So the additional $100,000 will be profit, right? So this is something that we all understand. It's a common understanding. So under this safety of capital, the clause 3122, it says that, okay, 312, what the 312 says, after within the subtopics of safety of capital, one of the important aspect is there has to be a liquidation, actual or constructive liquidation. Actual liquidation would basically mean that we just sell everything and get our capital back or profit or whatever. And constructive liquidation would mean that we will just value, we will just evaluate the current value of the investments made, the expenses, etc. And based on that, we realize the profit. I think you have gone through those concepts in many other Sharia standards, in other Sharia standards. So this is just a repetition of the same. Now, when we are doing the actual or constructive liquidation, in case of a Mudaraba investment account, we will have to take account of the expenses, because without the expenses, we will not be able to do the liquidation, either actual or constructive. Now, what are the expenses that will be included or considered as an expense that can be deducted from the revenues of this Mudaraba investment account? So that is the crux of the matter. So in this clause, it says expenses related to utilization of balances of the investment accounts by charging each operation with the direct expenses incurred in its execution. That any expense which is related to the utilization of the balance of the investment account can be deducted if it is a direct expense in its execution. So to maintain the investment account, we may have some expenses directly related to this maintaining of these investment accounts. So this is something we can consider as an expense for such Mudaraba operations. Then the share of the balances of the investment account from shared expenses, excluding expenses related to the institution's own activities. So there could be some shared expenses. So let's say that a financial institution has several deposit pools. One is Mudaraba investment. There could be other Mudaraba pool and different other pool. And all of the pool are given some shared services, direct expenses, however shared. So those shared expenses can also be proportionately considered as expenses to this Mudaraba investment account. However, excluding expenses relating to the institution's own activities, because those are indirect expenses. Indirect expenses cannot be considered as an expense to the Mudaraba. So that's basically the original clause. Now the questioner, he has a question now based on this. Why is the Mudarib not allowed to expense these costs in this situation? Now, which costs? Investment account should also not be charged with the expenses of the tasks which have to be performed by the Mudarib. Such expenses include the expenses of the investment departments and the bodies which endorse their decisions, as well as the expense of the follow-up and accounting departments. Okay, so this was one. And then if we look at the previous one, actually is not related to this. He just wanted to get a clarification of the last line. I will just go back and then clarify that. But let's say for this particular one, the question is, why cannot, in other words, why cannot we charge a fee for the transportation, for the storage, or any other related expense for the investment accounts? So I think the principle is same. In overall Mudaraba pool, We can only charge the expenses which are directly incurred for such investment accounts. So if we can justify that the transportation was only meant, it's directly for the sake of this investment account. I'm not saying that it is only for investment account. It could be shared as well, but it is a direct expense for this investment account, then it could be justified. But if it is something that the institution as a financial institution has to do, no matter what, if the investment account is there or not, then it is difficult to justify. End of the day, it's all about justification. So if it could be justified that it's a direct expense of this particular mudaraba pool, even though it is shared, then we can deduct as an expense. If we cannot justify, then we cannot consider this as an expense from the mudaraba investment pool. Now, what is the thamara of these two scenarios? What is the outcome of those two different considerations? If we consider those additional expenses which are not linked directly with the investment accounts, then definitely the expenses will be higher. And the expenses are higher, then the profitability will be lower. The investments accounts holders may lose potential profits as well, or their capital even. So this is something that needs really very important caution for the financial institution, so that they don't breach the rights of the investment accounts, knowingly or unknowingly. I mean, the maximum caution then what can take. Okay, now going back to the previous clause, which we tried to understand that actually he wanted to just get a clarification of the last line. So let's go again. It's under clause 2, which is basically the difference between an investment account and a current account. So it's the 5th subclause. Okay. In case of depositing coins or paper money, by handling them over to the cashier, the institution may charge a fee for transportation, storage, and counting of the deposited amounts. This, however, does not include amounts transferred to the account of institution. Okay, so when we deposit funds, if we go at the previous clauses, let's say this clause in 224, it says the institution may charge fees for the services of opening investment accounts. So this fee could be like a lump sum of, this has to be a lump sum, meaning that it shouldn't be a variable amount. It should be a fixed amount. We should preferably not exceed the average actual cost, and should be charged once the time of opening the account. Okay, I think this is straightforward. And then the clause is saying, in case we are depositing physical coins or physical paper money, and it requires some transportation from one branch to another, some storage, some counting of the deposited amounts. This also, okay, this however does not include amounts transferred. Okay, in case of deposit, okay, the institution may charge a fee. So the institution may charge a fee. Now, the difference between this and when we consider the expenses previously is this is a part of the, this is not considered an action, a function within the mudaraba. This is where the Rabbul Mal, the capital provider, is providing their funds, their investment amount. So to facilitate that, there is some costs incurred: transportation, storage, counting, whatever expenses. For that, the institution may charge a lump sum fee. Again, not a variable fee, a lump sum fee, as close as much as close possible to the actual charge that it incurs. Maybe by looking at the salaries or the operational cost that it has to bear. So that is just to facilitate the payment of the capital or the payment of the mudaraba investment amount to the institution. Once the payment comes into the institution, forms or pooled within the mudaraba pool, now then is the next clause. Remember the other clause that we have just read through. So this is where we will see after, when we are doing actual or constructive liquidation, we will see what are the expenses that can be directly attributed to this investment account. this is not direct attribution. This one is already done. It was just to facilitate the transfer of funds from the Rabbul Mal to this bank, financial institution, to the Mudarib. That's it. So that's a separate thing. And for that separate service, the institution may charge all those things that is mentioned here. But after it is part of the Mudaraba and the Mudaraba has made some profit or loss, now when it comes to actual liquidation or constructive liquidation, can we consider this as expense? The answer is no. Because in that case, we will not be able to attribute this particular task as a direct expense of the investment account. So end of the day, what is the rationale behind? The rationale is same. That's what I'm trying to emphasize on. The rationale is if the task or expense can be related as a direct expense or attributed as a direct expense to the Mudaraba, then we can deduct from its revenues so that we can understand the profit. We can calculate the profit. But if we cannot consider this as a direct expense, rather it's a function of the institution, financial institution, then we'll not be able to deduct it as the expense of Mudaraba. It is not saying that we cannot charge fees. You can charge fees if there is a cost separately, as mentioned in this clause. So I hope this one is clarified. Then the next question we have, I'm just going through the questions that we have received. There are a few more actually only. Then inshallah we'll go to the questions that received in this Q&A box. So the next question is about Ju'ala, SS15. SS15 Ju'ala. Just a quick recap while I open Ju'ala. Ju'ala is a specific type of contract where the Ja'il, the one who gives the fee, is similar to Ijara in the sense that some sort of tasks or not tasks, rather I would say some sort of outcomes are expected and a fee is paid. So from that point of view, since there is a fee paid, we can see some similarity with Ijara. But the difference is in Ijara, we can define what is the work that must be done by the Amil, by the worker, by the labor, by the employee. But in Ju'ala, we cannot define the work. We can define the outcome of the work. For example, we can say whoever can extract, X amount of petrol, oil, or X amount of gold, silver, whatever, from under the mud, under the ground, or any other such task, or maybe whoever can recover the debts, the liabilities that the clients owe to us, they will get X percentage of the amount. They will get a lump sum. So that lump sum or that X percentage is similar to ujra, similar to fee. But the thing is, we cannot define the work. So the work may be 1 hour, it could be 100 hours. We only pay when the outcome has been achieved. So that's the difference between Ju'ala and Ijara. All right, so the question is about it's clause number 4. Let's go to clause number 4. Okay, the clause number 4 is about Sharia status of Ju'ala. Okay, let me read the question. What does it mean if the worker undertakes not to revoke the contract during a specified period? How does it become binding on the worker? Okay, so then he puts the entire clause. Okay, let's read the clause. So in this subsection of the standard, the objective is just to mention the Sharia status of Ju'ala. What it is saying is that with due consideration to item 6 below in respect to the revocation of Ju'ala, Ju'ala in principle is not a binding contract. So this is first thing. Ju'ala in principle is not a binding contract, because remember, as I mentioned, in Ju'ala, it is not necessary that I have a contract with one employee or one worker or one labor. Rather, it could be an open invitation. So whoever can achieve the outcome, he will get the fee or the reward. So the general offerer, the offerer is called Ja'il, and the worker, Amil, are entitled to revoke it unilaterally. So in general, both can revoke the contract unilaterally. However, it becomes binding for the Ja'il when the worker commences work. So if someone starts working based on the announcement, let's say the Ja'il, the one who offers, he gave an announcement that whoever can get this outcome, I will pay X amount or X percentage. In general, it's not binding, but if someone starts working based on that, then it becomes binding. Why? The reason, the rationale behind is to do justice with him, because he already started working based on that offer. Now, if we say that the offerer can just revoke, then he will be in loss. He has put his efforts, maybe he has made some investments, etc., etc. Okay, now if the worker undertakes not to revoke the contract during a specified period, it is binding on him to abide by the undertaking. So on the jail, it is binding when the worker starts working for it. On the worker, it is binding if he makes an undertaking, he makes a promise that I promise or I undertake that I will not revoke the contract unilaterally until I finish, or maybe within the specified period. So in that case, it will be binding on him as well. Okay, now let's go back to the question that the questioner asked. He said, what does it mean if the worker undertakes not to revoke the contract during a specified period? How does it become binding on the worker? Okay, I believe it is already answered. For the worker, if he undertakes that he will not revoke, so it becomes binding. Now, how it becomes binding? What does it mean? What is the implication? The implication is that if, let's say, after putting this undertaking, he has already commenced the work, and the next day he says, sorry, I cannot work. Now, there is a hadith where Prophet ﷺ said, Al-Muslimuna ala shurutihim. The Muslims abide by the conditions that they put. Then there are verses also. Allah subhanahu wa ta'ala mentioned in Surah Al-Ma'idah, the very first verse, Ya ayyuhalladhina amanu awfu bil uqud. O believers, fulfill your contracts, fulfill your agreements. Now, even though this is not an agreement, right? But still, since he made a wa'd, since he made a promise, and now if he revokes unilaterally, even after making this wa'd, this may be an injustice to the jail. Maybe he thought that, okay, this worker is already working for me, so he is no longer looking for anyone else. And suddenly, this worker says, no, sorry, I cannot work. So that will be an injustice. So what is the way around? Can he? I mean, is he bound to just work no matter what? No, he can still negotiate with the jail. What it means is that he cannot revoke unilaterally, but of course, with mutual consent, any contract at any stage can be revoked, because with mutual consent, both parties consent in a point that Sharia will consider it as a just, as a fair. So no issue, no zulum, no oppression, nothing. So that is also fine, no issue. I hope you got the answer. The next question is from the very first standard, which is trading in currencies. It says, why a bilateral? By the way, this standard discusses the rules and regulations for exchanging currencies, different currencies or similar currencies, etc. So the question is, why a bilateral promise to purchase and sell currencies is forbidden if the promise is binding? However, a binding promise from one party is permissible. Okay, so I think I know where it is. Somewhere, most probably. Possession. Okay. Agency. Here. Okay. So basically, his question is, why is bilateral promise? Sorry. Yeah. Why is bilateral promise to purchase and sell currencies is forbidden? Okay, if the promise is binding. However, a promise from one party is permissible even if the promise is binding. So in other words, he's asking, what is the difference? So the difference is, in bilateral promise, when it is binding, the difference between that and a contract is very thin, because the implication of a binding bilateral contract is the court will force them to execute the contract, right? So the difference between that and an actual contract is very thin. Now, if we consider that similar to a contract, then the issue that happens when if it is a contract will also apply here. So what would happen if it was a contract? Can we have a contract to sell currencies, purchase currencies at a future date? Cannot, because in that case, we will not have the spot possession, which is a fundamental requirement when we are dealing with currencies. Similarly, having a binding bilateral promise to sell or purchase currencies in a future date will also be forbidden for the same rationale, because we cannot differentiate between these bilateral binding promise. What is bilateral binding promise? So let's say an agreement. What is an agreement? Both parties will say that this party A and party B agrees to sell or purchase this currency at this specified future date, blah, blah, blah. So both parties sign. So we are saying this is forbidden. Now let's consider bilateral promise. It's the same thing. Instead of we agree we have agree to have this contract, we'll say we agree to promise, or we promise, right? So it will still be signed by both parties. So we see very thin difference from the lens of fiqh, and that's why it is considered similar to contract and it is forbidden. Now the case of unilateral promise. Firstly, unilateral promise is not like bilateral promise. Unilateral promise, only one party will sign, that I promise, we promise. Both parties do not sign in there. So it is still considered a promise. Now the issue is, it's still binding, right? We are talking about the case where it is binding. If it is not binding, then no, I believe the questioner will have no question. But the question arises that it is still binding. Yes, it is binding, but it is binding on one party only, right? So the other party, for them, still it's a choice. So we see a big difference between this and our contract. However, in the case of bilateral contract, bilateral promise, which is binding, we see almost no difference between that and a contract. Hence, the Sharia status of both is different. Okay, then next question is about the Sharia standard on murabaha. I believe it's a very important standard, from the sense that many of the transactions around the globe in Islamic financial industry are based on murabaha. Okay, so again, murabaha is a contract where one party or the seller sells something while disclosing either his cost or profit. Right, so that's the only difference. Basically, he's selling at a profit, but he's disclosing how much profit he's making, or the cost price. So in a banking scenario or a financial institution scenario, the goods murabaha, if we call it, it's not a commodity murabaha, by the way. Commodity murabaha is in AAOIFI Sharia standards is known as tawarruq. It is a different Sharia standard. But in murabaha, we mean goods murabaha. So in goods murabaha, the financial institution will purchase the asset from a supplier, from a vendor, and then sell on a murabaha basis to the client. So we have two different contracts here. Okay, so the question is saying, I got a scenario in exam that Mr. A owns a hotel and had a murabaha contract with the bank, and the supplier is Mr. A's brother. If in murabaha sales, if the supplier is relative, will it give rise to bay al-aina? Okay, it's a good question. If in murabaha, so basically, what is the crux of the matter here is that if I'm buying from the one that I have sold to, then it will be considered as bay al-aina or buyback, right? So let's say the bank, first, Mr. A, he owns a hotel, and he had a contract with bank, and the supplier of this murabaha is Mr. A's brother. So he has a hotel, maybe he has to purchase something, and he goes to the bank, asks for a murabaha financing, and the asset or the supplier, the vendor here, will be from his own brother. So the question is, if bank purchases from his brother and sells to him, will it be considered bay'ul aina because it's his relative, right? So firstly, I don't think it will be aina. The reason being is that the rationale is the bank is having murabaha with the brother. Sorry, the bank is having the contract with the brother, Mr. A's brother, and usually it's a normal sale contract, whatever it is. So the bank is the purchaser of the asset, and then the bank is selling to another brother, let's say Mr. A, right? So in between, the bank has been one of the parties. So in the first sale, the bank is the purchaser. In the second sale, the bank is the buyer, seller. So between the end client, who is Mr. A, with the end client, the seller is bank, and bank did not purchase from Mr. A. Bank has purchased from Mr. A's brother. Aina will only happen if the bank has purchased from Mr. A himself, or maybe a company which is majority owned by Mr. A, or maybe Mr. A is not a individual. He also is a company. Let's say company A, and between that company and the vendor, there is a shareholding of 50% or more. So in all such cases, we will consider the vendor and the end client as one single entity or one single person. And that is when it will become aina. Otherwise, every single individual, even if the person is the wife or brother or any other relationship, it will still be considered as a separate person because the ownership is different. However, I think that the bank needs to further scrutinize and do further due diligence and to ensure that even though the business or the vendor is Mr. A's brother, but behind the scene, they don't have a prior, contractual relationship. If there was a prior contract relationship, or maybe Mr. A is just showing his brother as a vendor just to deceive the financial institution, end of the day, there is no such transaction, it's a fake transaction, this and that. So that will be problematic Sharia wise, but not because he is his brother, because of the ingenuity of the transaction itself. So I hope this is clear. And then similarly, another question he asked, the same person, suppose supply of poultry supplies of poultry item, and if the chicken dies after sale is made, does the purchase has right to recover his loss? Does the purchaser has the right to recover his loss? So let's say in murabaha. In murabaha, the financial entity has purchased some chickens or such other livestock, goat, cow, or whatever, and then after purchasing, selling to the end client. Now, after purchasing, before selling, if the livestock dies, who takes the risk? So generally, the risk must be borne by the financial institution because the financial institution has taken the ownership and possession, and that comes with the risk as well. However, in practice, we see usually the contract is designed operationally in a way that the financial institution doesn't usually have to take the risk. Now, who will bear the risk? The risk somehow is transferred to the client. So that's why Sharia issues will come. Whoever sits as a Sharia advisor or Sharia reviewer or Sharia researcher needs to have a very close look here, because once the ownership is transferred to the financial institution and the possession has already also been transferred, then the risk is transferred as well. And at that phase, if something happens, they have to take the risk. So I hope this is clear as well. Okay, now comes to commercial paper. This is, I think, on the second last question from the questions that I have. And then inshallah, we'll come back to the questions in Zoom. So this question is about this standard. commercial papers. Okay, so what is the question? It says, why is it not permissible to use a bill of exchange or promissory note in transactions that require possession of counter values, such as currency exchange or a counter value for the capital of Salam? Okay, so basically what is the questioner asking is that, why cannot we use promissory note or bill of exchange, such commercial papers, in transactions where it requires spot possession, all right? For example, currencies. When we deal with currencies, it's a must that both parties should possess the currency on spot. Of course, there are some leeways given due to international transactional delays. That's a different issue altogether. Now the question is, why cannot we use bill of exchange and promissory note to pay or use as one of the counter values? The reason is, in both promissory note and bill of exchange, the payment is made after a certain time period. The payment is not made instantly. It's not cleared instantly. In promissory note, as the name suggests, it's a note where the issuer of the note promises to pay after a certain time period. And the bill of exchange is also similar. It's just that the bill is exchangeable. Of course, both of those can have certainty in payment depending on the issuer, but it's not a payment. There is a difference between certainty of payment and payment. So that's why it may not be considered as a counter value for either currencies of exchange or even Salam. In Salam, it is a must to pay the entire capital upfront, the entire capital meaning entire price of the goods upfront. So we cannot utilize any instrument which defers or delays the payment. So since promissory note and bill of exchange, it causes delay in payment, we cannot utilize those as Salam capital. So I think those are the questions that we have received within the forms, and now I can go inshallah to the Q&A section. Okay, so from Murad Ubaid, we can see أنا سجلت للامتحان بشهر سبتمبر حسب ما تم إفادتي به. السؤال في حال عدم اجتياز الامتحان بنجاح، هل لدي فرصة لإعادته بشهر 3 من عام in March? So what he's asking is that he has registered for the exam in September, and in case if he fails, can he take another attempt in March 2024? Brother Obaid, I think based on the information we have received so far, it will not be possible because the last attempt to take retake exams will be in September. However, if AAOIFI changes the decision, that could be possible, but based on the information that we have until now, it will not be possible. Okay, what is the difference between IMBA, Ijara, wal-Iqtina, wal-Mawsufa bil-Dhimma? So Ijara Muntahiya bit-Tamlik is what we have already discussed, where the Ijara ends with transfer of ownership. Ijara Mawsufa bil-Dhimma is just a type of Ijara where we are not giving the service right away, rather the service is deferred. You can think of similar to Salam in case of sale contracts. What happens in Salam? I pay upfront, I get the commodity later on. So in Ijara, we agree now, but the service will be delivered in a future time period. Of course, unlike Salam, we don't have to pay right away. The payment can also be deferred, meaning the payment of fees, the payment of rentals can also be deferred. So let's say now it's 1st of June. So we agree for an office space, we agree for a tenancy for a housing, that the tenancy or the will start, let's say in September. Can we do that now? Can we agree now? Yes. So once we agree now, it will be considered Ijara Mawsufa fi Dhimma. Mawsufa fi Dhimma is meaning that it will be specified within the Dhimma, within the liability, meaning that we are not specifying the asset itself right away. Moreover, I can further explain Ijara Mawsufa fi Dhimma in a manner so that we may not be able to even say that this house we are going to rent to you. Rather, we mawsuf it, we make it mawsuf, we make it defined through the different attributes, the features. but we don't have the actual asset, which we tell that, okay, this is the asset that you're going to have. So once we define within the attributes, which will be delivered, which will be given at a later point of time, this is exactly ijara mawsufa fi dhimma. Ijara wa iktina, ijara wa iktina, I believe it's similar to ijara muntahiya bit-tamlik. The difference could be that there is usually a hiba at the end. You know, in ijara muntahiya bit-tamlik, the transfer of ownership, it can be based on sale, it can be based on hiba as well, as a gift as well. So usually ijara wa iktina, in my understanding so far, it refers to when the ijara ends with the transfer of ownership based on hiba. That's in general, I believe that answers your question. Okay. Next question is, Assalamu alaikum, and thank you for the session. Thank you too for attending. Next question, is it permissible for an active partner in musharaka contract to be entitled to salary and profit? Okay, very good question. So in musharaka or in mudaraba, the entrepreneur, the active partner, they may not take fixed profits or fixed revenues or salaries. Rather, they will take a portion of profit, a profit share, right? That's the general rule. But in today's context, usually mudarib, usually sharik, the partner, they may provide services additional to just managing the overall business. Maybe he will also provide some of his skills or experiences of accounting, of marketing, of something else. So based on those, the entity, the company, or the musharaka can hire him based on a separate employment contract with defined services and defined payment, defined salary, or defined fees. So what I mean by separate is, according to AAOIFI standards, both contracts would not be interlinked. So we on one hand, let's say we have an employment contract or a service contract or a consultancy agreement. On the other hand, we have with him shareholders agreement or subscription agreement or musharaka, whatever. So if for whatever reason he sells his shares, he exits the musharaka, he is still a service provider. If for whatever reason he is no longer a service provider, he terminates this contract, he is still a sharik. So there shouldn't be any interlinkage between the two contracts. So if that is done, then based on that separate employment agreement or consultancy agreement, there could be a separate, specific salary. Very rich and determined. Thank you so much, Dr. Makiu. Okay, from Junian Salam, can we please do some sample questions from different standards and discuss them? Yes, sure. I think previously when you used to conduct this session, we used to have some sample questions like quizzes. You can, find such sessions in YouTube, in TAIF's official YouTube channels. However, the format today that we are adopting is we receive questions from you, from the audience, and we try to address those. If you want to go for more specific questions, I think there is a question bank from Taif, maybe Brother Hassan. You can enlighten us later on this, inshallah. So I will consider this as answered. Okay, next question from Ahmad Afandi. How to determine just and fair ratio of profit and loss sharing? Sorry, since the mudarib will not earn income during the first period of contract. Okay. So the mudarib, as I mentioned, there are two dimensions of this question. Firstly, for the mudarib to earn income, as I was just explaining, there is a possibility for him to earn income with a separate contract as per AAOIFI standards, as I mentioned just now. So that is one way. But even if we consider that the mudarib is not earning a fixed salaried income, so in that case we can have a higher profit sharing ratio with him. So maybe let's say we can have 60%, 70%, 80% for him. Now, what is just and fair? Uh, to be honest, there is no black and white rule for a just and fair profit sharing ratio. It is completely depending on the musawama, on the negotiation between the two parties. If the two parties agree for a profit sharing ratio, let's say 90% and 10%, so 90% for Mudarib and 10% for the Rabbul Mal, or even vice versa, the moment they agree, Sharia will consider this as just and fair, because this is a bit of gray area. So it is completely left to the negotiation between the parties. Of course, each and every party should always try to do ihsan, not just fair, but rather excellence beyond that. So if I know as a Rabbul Mal, I know that the Mudarib is agreeing with me for a lower profit sharing ratio just because he doesn't have money, just because he has a lower hand in this negotiation. So I should offer, why not you get another 10%? So that's the mindset and that's the attitude we should have as Muslims. You can refer to the AAOIFI Code of Ethics for Islamic finance practitioners. It's a wonderful and amazing code of ethics. I never saw any such code of ethics throughout the world. So in that, inshallah, you'll see the implications of ihsan. One should practice in everything. So I believe for just and fair, there is no hard rule. But all of us, if we try to do ihsan and negotiate onto something, agree onto something, then done. Once we agree, it is considered as just and fair. Okay, the next question from same person, Afandi. Can we adopt income smoothing, range of income for Mudaraba? Uh, the scenario of income smoothing is not so clear to me right now. But if I'm not mistaken, where you have basically a range, a bit of variability, right? So from the profit sharing ratio point of view, it has to be determined. We cannot say, okay, you will receive up to 40%. No, because there is uncertainty. We cannot have uncertainty in the ratio itself. Now, after the ratio is determined, we can agree on something like that okay, within this ratio, you will receive up to 7% ROI. Uh, uh, or 7%, yeah, up to 7% ROI. And if the profit based on the profit sharing ratio, if the profit reaches beyond 7%, that will go to one of the parties, let's say to the Mudarib, that can go to a profit sharing, profit equalization reserve, profit smoothing reserve, income smoothing reserve. So we can play around with it, no problem. As long as the mechanism doesn't create a barrier or deprivation for either of the party completely from the profit, it is allowed. We can be creative. We can have a smoothing arrangement, no problem. There are two rules. Number one, there cannot be any jahala, any uncertainty regarding the profit sharing ratio itself. And number two, within the profit sharing ratio mechanism, we cannot have any such mechanism where either of the parties are completely deprived of from profit in any scenario. If we keep those two principles in mind, then I think there are creative ways to do the income smoothing, inshallah. Okay, next question from Fayaz Khan. Can we have a look on the commercial paper standard, especially of discounting of commercial papers area? Yes, definitely we can. And please be more specific about the clause of the section. So when I navigate, I can save some time. I believe you have been asking about this part. Okay. So discounting of commercial papers. Yeah. So first and foremost, what is discounting of commercial papers? Discounting of commercial paper means that I purchase the commercial paper at a discount. So let's say promissory note, which I mentioned about earlier. Promissory note where a company promises that they will pay, let's say, $5,000 after 2 months. Now, this note, this promise, this document is brought forward to a financial institution, and they're offering, why not you sell us sell to us this note for, let's say, $4,800 or $4,500. So the rest $500 is a margin, is a profit for the institution, which they can avail at the maturity, let's say after 2 months. So they buy now at a discount and they get the full amount at the maturity period from the issuer of the note, from the debtor, the original debtor who issued this note. Now the question is it allowed? It's not allowed, because with this we are basically indulging into a riba and nasi'ah. Riba and nasi'ah refers to a riba which incurs due to increase based on deferment of payables or deferment of debts. So here, basically, why and how the institution is earning their $200 or $500. This is because he's exchanging with a deferment of debt. So there is one way to look at from the riba and nasi'ah point of view. Also, it could be considered as a selling of debt, which is also from Sharia point of view is problematic. So I think there is also already some clarity here. Let's read it quickly. So first and foremost, it says it's not permissible to discount commercial papers, but of course it is permitted to pay an amount that is less than the value of the paper to the first beneficiary prior to the date of maturity. So let's say the company A has a transaction with company B, and due to the transaction, the company A had to issue a promissory note of $5,000 to company B, meaning that the company A is saying, we will pay you after 2 months the debt amount of $5,000. Now, if before the date, they go back to company B and say, yeah, why not you give us some discount? We will settle it right away. So they negotiate and they agree that they will pay only $4,500 and it will be considered completely settled. So is it permissible? Yes, it is permissible. Why? Because it's not actually exchanging the debt with some other parties. Rather, it's actually waiving the right to some of the debts or some of the receivables by the original beneficiary or by the actual creditor, so that it's no issue. But when we sell the commercial paper to another party, which is not due yet, as I mentioned, let's say it will become due in next 2 months for an amount similar to its value. So it's a $5,000 promissory note, and it will be paid by the original payer after 2 months, meaning the maturity will be after 2 months. It's not due yet. And we are selling it for $5,000 itself, meaning we are going to a financial institution and saying, I'm going to get paid in 2 months. Why not you just pay me now and you get the payment after 2 months? So what happens at that point of time, it becomes riba al-nasi'ah, the one that I mentioned, that I'm exchanging the $5,000. The institution is giving $5,000 for what? For a debt of $5,000. So in one hand, it's a deferred payment. It's a debt, sorry, not deferred payment, it's a debt. We are exchanging the debt with so that will make it a riba al-nasi'ah. Just like when we exchange currencies, so if one of the counter value is deferred, same thing happens there as well. However, if we exchange for an amount more than its value, then it becomes also riba al-nasi'ah because of the debt part, and riba al-fadl because of the increased portion. So riba al-nasi'ah and riba al-fadl basically are two prominent types of riba that are extensively discussed in the fiqh literature. Okay, then it says it is permissible to the beneficiary to treat commercial paper that is not yet due as price for ascertained goods or usufruct, but not those are sold by description as a liability with the condition of actual or legal delivery of goods or usufructory asset. Okay, let's consider my previous example where company A had a debt owed to company B, and that's why they issued a promissory note, okay, of $5,000. Now, company A wants to buy, company B wants to buy something from company A. They say, okay, you already owe us $5,000, right? So why not you consider theirs as a payment for some goods and services we buy from you? So if the goods are ascertained, if the services are ascertained, meaning that we know that these are the goods, these are the services. It's already there, it's mawjood, it's ascertained. It's not something on liability. It's not mawsufa fi dhimma. It's not that it's a description as a to be delivered or to be prepared in a future date. So in that case, we can settle that promissory notes debt against the price of these goods. So that is fine. But if it's okay, the question is how it will be considered as done, because on one hand it's a deferred payment, right? Company A is supposed to pay at a future date, and on the other hand it's not deferred, it's a spot. The goods and services are delivered at a spot, right? So the deferred payment against a spot goods or services, it's a valid sale. That's exactly what we do in usual banking murabaha sale. However, if the assets and goods are not delivered in a spot, rather sold by description, meaning that it has to be created, prepared, or acquired, so it's a debt as well, similar to salam. So on one hand, the commodity is deferred. On the other hand, the price is also deferred. Remember, the price was to be paid in 2 months, right? So the note actually represents a debt. So what is happening here? It's a sale of debt with debt, or in other words, not debt by debt. It's a sale of deferred with deferred. So both of the counter values are deferred. Now, what is the problem here? The problem is in any sale contract, if both the counter values are deferred at the same time, Sharia doesn't recognize it as a proper sale. There is a hadith where Prophet ﷺ prohibited bay'ul kali bil kali, sale of deferred for deferred. That's why you see either the price needs to be paid, or either like in salam contract, or the goods must be delivered in many other deferred payment contracts. I believe it's understood. Lastly, it says the holder of commercial paper is permitted to purchase goods to be delivered later on the date of maturity of the paper, and after the debt is established as a liability. The holder of the paper transfers the claim of his creditor to his debtor through this paper. In such a case, the transaction amounts to hawala. Okay, in the previous one, we mentioned about the commercial paper which is not yet due. Remember this point. But here we are saying which is already due. The debt is established as a liability, meaning that the commercial paper has already become matured. It must be paid now. Now, if we use this commercial paper to purchase goods, that goods will be delivered later. So now what's happening here? The goods are deferred, but the price is not deferred. The price will be considered spot. Why? Because it's already due. The only thing is the price is not being paid by the holder of commercial paper himself. Rather, what he is saying is that, I have this commercial paper. This commercial paper is issued by that company. So go to that company and collect my receivable from them. So this is what exactly we call hawala. Hawala is transfer of debt. I am transferring my receivable to another person, that you go there and you collect the receivable on behalf of me, so that will settle the transaction. Anyway, end of the day, the rationale here is we have two counter values. So one of the counter value is goods. It is already spot. It is delivered later. On the other hand, the paper represents a debt, represents a receivable which is already due, and there is certainty to be received, and it will be received through hawala. So I hope the explanation makes sense to the one who you asked, Mr. Fayaz Khan. If there is further question there, we'll try to answer again. Okay, Muwahid Billah says, can you go over the difference between Arboon and Hamish Jiddiya? Sure. Hamish Jiddiya comes at a point of promise, the stage of promise. If you go to the Murabaha Sharia standard. So before the deal is concluded, the customer, the client of the bank, promises to the financial institution that I promise I will purchase this asset from you if you purchase this asset from that vendor, right? So at that point, to ensure that he keeps the promise, the financial institution may demand from him a hamid jiddiya. It's a payment just to ensure that he keeps his promise. Jiddiya is to make it, to strengthen it. Jiddiya means to strengthen it. So it's just a way of strengthening his promise that he will keep his promise. Now, after that, what happens if he backs out? So in that case, the financial institution can sell the asset to someone else, right? Another third party, and recover the actual loss from this Hamish Jiddiya. They cannot freeze the entire amount. They can only recover the actual loss. How do we compute actual loss? It is mentioned in the standard, but just to recap, let's say the bank has purchased the asset from the vendor at, let's say, $100,000, and it was supposed to sell to the client at $115,000 with a 15% margin. Now, once the customer backed out, it had to sell to someone else. And when selling to someone else, it could only recover, let's say, $100,000. It was supposed to sell at 115, and it was only able to recover $100,000. So should we consider it as an actual loss? No, because the bank was still able to recover what it spent, right? So it cannot take any amount from Hamid Jiddiya. It has to return 100% Hamid Jiddiya to the client. Next scenario, the bank was able to sell it at, let's say, 115. So in that case, same, it will not be able to recover or freeze any money from Hamid Jiddiya because it was already able to recover the capital as well as make some profit. The third scenario, the bank was only able to sell it to the third party, let's say at $95,000. Here, there is an actual loss of $5,000. So let's say the Hamid Jiddiya was $10,000. So in this case, the bank will be able to recover $5,000 from this Hamid Jiddiya, and the rest $5,000, it must return back to the client. So this is Hamid Jiddiya. It comes at a promise stage. Arbun comes at a stage where the contract has already been concluded. It's an upfront payment after the contract concluded, that, I'm making 10% payment now, but I will come back, let's say within a week or so, and make the rest of the payment. What happens if I don't come within next 1 week or so, or I just mentioned that I cannot proceed with the contract? So in that case, the bank can freeze the entire Arbun amount. They have the right. However, it is still recommended based on the AAOIFI standards that the bank only recovers actual loss and returns the remaining part, similar to what it does for Hamid Jiddiya. So this is the difference. The end of the day, Hamid Jiddiya comes at a promise stage. The bank can only recover the actual loss. Arbun comes after the contract is concluded, and the bank is entitled to freeze the entire amount. However, it's an ihsan. It's recommended that the bank only recovers actual loss from the amount. So I hope you get a good summary of the thing. Okay, next question from someone who chose not to reveal the name. It's fine. Sheikh, I will be able to make it. Yes, brother Asan, you wanted to make a comment? Sorry.
Assalamu alaikum. No, Sheikh, I was earlier there was some distortion here, so I just wanted to, I'm available here in case any question or something.
Oh, sorry, I missed your earlier message. Okay, maybe a bit later, inshallah, let us just quickly finish some of the remaining parts, so then we can take the questions. Is it fine for you?
No problem, Sheikh, I'm here.
Okay, khalas, inshallah. So just a few, I think, it is permissible for debit card holder to withdraw beyond his available fund. I'm a bit confused with standard number 2, clause 451. Okay, let's navigate there. So this is the second standard. Second standard, clause number 451. Okay, so it says it is permissible for the cardholder to withdraw an amount of cash within the limit of his funds or more with the agreement of the institution issuing the card, provided no interest is charged. Okay, so if I think the camera is, the camera went down, is it? Can you please confirm? Sorry for the inconvenience. Let me plug in. Sorry, I think the video was off. Okay, so, okay. Jazakallah khairan. So in this clause, what it is saying is that the question is, is it permissible for debit card holder to withdraw beyond his available fund? Okay. Now, what happens if the fund is not available? So definitely the institution will lend the money, right? It will lend the money to the card holder. So the question would be, is the lending based on interest or not? If it is based on interest, then it is not permissible. If it is not based on interest, it's a qard hasan, then no issue. The debit card holder can still withdraw the fund, even if it's not in his account. Okay, the next question. It is something challenging for customers having conventional loans to transfer to Islamic banks without paying those loans. Is it permissible for the Islamic bank to settle this debt and later deduct from the customer? If yes, how can the bank gain from this transaction? The question would be, how can the bank settle the loans on behalf of the clients? So if they have to settle with interest, it still is the same thing. It's just that the customer is not paying directly from his own wallet, rather is asking the bank or financial institution to pay on his behalf as a loan extended to him, which will later be recovered from his account or from other way of means. So I think there is no difference. Either the customer pays himself or the convention or the Islamic financial institution is helping him. And now, how can the bank gain from this transaction? I have no idea because there is no such assets or services involved. When it's just cash provided to the customer, let's say, regardless of paying off conventional loans, if we consider what happened here, the bank is just giving some loans to the customer, right? So in that case, the only charge the bank can take is the actual charges that it has incurred throughout this process. So, for example, it has to utilize some, maybe it has to pay some third party or some additional expenses incurred. There is a comprehensive Sharia standard issued by AAOIFI, most probably Sharia standard number 61. On I think it's also recently translated, which is bitaqat al-daf'i, or payment cards. In that Sharia standard, the actual charges are defined, like what would be considered as actual charges and what would be considered not as actual charges. So I think the bank can only charge actual cost. It cannot charge anything additional to that because it's just facilitating some loan to the customer. Of course, if there are some asset-based financing or other way to finance it, that is different. Okay, I believe I have tried to answer the question. Trading of currency. Fayaz Khan asking, trading of currency, why a bilateral promise to purchase and sell currency is forbidden if the promise is, oh, I think this is the same question we have already answered. Okay, I am done with all the questions that has been asked. I think I will go back to Brother Ahsan. And all of you, we wish you a very good luck in the exams. Brother Ahsan, I think you can answer about that part where someone asked like how can they prepare if there is any mock questions available, etc. You can take it from Taif point of view, please. Jazakumullah khairan.
Assalamu alaikum, everyone. Thank you very much, Shay, for this remarkable live Q&A session, jointly organized by Taif and Adil Advisory. It has come to an end. I would like to extend my heartfelt gratitude to Mufti Yusuf Sultan for his graciously sharing his valuable time, his knowledge, insight with us today. His expertise and his dedication towards helping Islamic finance industry is exceptional. Further, people who have attended the session today, I'm very happy that they have taken actively participated in asking the questions and acknowledging that the Sheikh have answers and given satisfactory explanation to all of them. Taif is very happy and always thankful for Adil Advisory to work together and bring such sessions to you all. With regards to the Q&A or sample mock questions, we have a batch of questions. I believe if you can send us an email separately on contact@taiflearning.com, I will send you over with the recording of the session. And those questions are given to us by our dear Sheikh Brother Siddiqui. Yeah, dear Sheikh Siddiqui from Faisal Bank. So perhaps you can take a look at those questions. They are not marked. So it's up to you to take a look into that and benefit from it. Sheikh, thank you very much for your time and coming here and enlightening us with this valuable session. I'm very grateful to work along with you.
Yeah, thank you so much, Brother Hassan and Taif team, entire Taif team, and my team at Adil Advisory as well. And I thank all the participants who have been listening to me so far. And I hope we try to answer most of the questions. If there is any other question, you can reach out to Taif as well as Adil. And inshallah, we'll try to help you. And we wish you and make dua that you all become successful ambassadors of Islamic finance industry through this very prestigious certification, CSAA from AAOIFI, inshallah. Jazakumullah khairan.
Jazakallah khairan. Thank you very much. This session is to an end now. Assalamu alaikum.
Assalamu alaikum.